Welcome, everyone. I'm thrilled you've decided to take control of your financial future tonight. Here's the truth. Wealth isn't about how much you earn, it's how much you keep. Tonight, we're going to cut through the noise and focus on what actually builds wealth, being purposeful with your cash flow, eliminating any of that static, getting rid of the mortgage around your neck, and executing on a smart strategy across property and managed funds. Most importantly, we'll help you calculate your retirement number because you can't hit a target you can't see. And we'll show you why working with the right advisor isn't just smart, it's essential for accountability and efficiency. Fear has kept too many people on the sidelines while their wealth building years slip away. Tonight, that changes. Let's get started. So we've got a packed agenda tonight. I will talk at pace. There's a wee chat box at the bottom of your screen. Please use it. Ask me anything, just here to help. And my amazing producer, Jess, will collate all of those questions and we'll go through them at the end. Also, we've had some really considered questions submitted prior, so we'll make sure we leave some space at the end to go through those together as well. So what we'll cover tonight is why you want to grow wealth. I think that's pretty obvious, but I will state the obvious to begin with. Harnessing your own natural tendencies around money. Remember that money success formula, 80% behavior, 20% strategy to get you to where you need to be. We'll talk about the wealth building blocks and principles we recommend our clients anchor themselves to going forward. Critically, we'll talk about how we calculate that retirement number, what it looks like to create a personalized wealth plan, your options, risk and reward, adjusting your plan for your individual goals, and then, as promised, we'll go through that Q&A. So you might be, in terms of disclaimer, this presentation is provided for information purposes only. The content of the presentation is not intended as a substitute for regulated financial advice. Of course, I'd love to give you specific advice, but to do that, I need to meet you. So we've got a super special that we're going to offer at the conclusion of this webinar to invite you to come and have a consult with a qualified financial advisor like myself. So a little teaser at the end. So you might be thinking, who am I to give you financial advice? So my name is Katie Wesney. I'm the head coach at Enable Me. Background is I am a chartered accountant, trained at KPMG many moons ago. And as I said, I'm also a qualified financial advisor. I've been at Enable Me for the last decade. Nothing I haven't seen. I love what we do. I've built and sold my own successful business. I've worked across Europe, US, and New Zealand, and I am a staff columnist and media commentator. At Enable Me, my job is to optimize outcomes for my clients and help them reach their financial potential. So let's figure out yours. So first off, I'm going to be super targeted tonight. So what do you currently invest in? New Zealand Super, KiwiSaver. Do you have an investment property, shares, managed funds, term deposits, high interest savings, or none at all? So if you just select what is relevant to you, again, I'll just make sure I'm super targeted in terms of audience. Right. So why should you? Oh, right, great. Poll result is in. Really interesting. Only 54% of you have KiwiSaver. I'm surprised it's so low. We're going to unpack that together. We've got quite a spread. Okay, New Zealand Super, interesting. Shares, managed funds, quite a big proportion as well. Very few in investment property. Interesting. Quite a few in savings and cash. Okay, no, I will adjust accordingly. Great. Thank you for sharing that with us. So why should you prioritize wealth? I think in essence, for most of my clients, it's just about creating more options, improving security. They're here to solve a problem. Generally, that problem is they want to be sorted for retirement. Lots of my clients say they'd like to help their kids and leave a legacy. My job is to make sure that I help them first, of course. And they're here to be ambitious. No one works with us to be fine. They're here because they want to make the most of their position, as you are tonight. And I think a really important anchor for my clients is they want to make sure they have a little bit more financial freedom, so kind of choice around the work they do, how long they work for. And that security element is really important for them as well. And growing wealth is essential for our financial well-being. And it does impact us on an everyday basis, even though we like to think that it doesn't, it really does. And so if you're feeling worried about this, please know that you're not alone. 44% of Kiwis feel prepared for retirement. 54% of Kiwis worry about money daily or weekly. And 70% of Kiwis expect they need to work past retirement age. The stats are sobering, and that's what we're here to challenge and make sure that we do work really hard to make sure that we have that really robust wealth creation strategy so we're not on the wrong side of these statistics. It is possible, but you need to be strategic and you need to start now. And I'm going to debunk some misconceptions around wealth. Wealth creation is not just for the ultra wealthy. It's really not. It's about everyday Kiwis being smarter and more strategic with what they have, to be honest. It does not require a lot of money to get started. It really does not. And and it's not another form of gambling where people lose all their money. And I think that lots of Kiwis are super conservative. But I'll tell you right now, the biggest cost quite often is that of doing nothing. And part of developing a really robust wealth creation strategy is to say to yourself, well, I'm taking doing nothing off the table and I'm going to execute on a really clinical plan that gets me to where we need to be. Is only, and again, it's just not for people with a finance education. And again, I am a chartered accountant, trained for 7 years, etc. And I work with lots of chartered accountants as clients, lawyers, builders, people of all walks of life. Again, there are rules around all of this. Part of my job is to instill those rules with the people I work with, the people I talk with, to make sure that you can do better. And it takes too much time because you have to do it every day. Absolutely not true. Often it's about making sure that you have really great structures and frameworks around your money. So the default position is success, not failure. And we're going to touch on that tonight. And I do acknowledge that there's lots of noise out there, particularly at the moment. Donald and his tariffs, um, the high inflation that we're hopefully getting to grips with, cost of living. But the price of butter is obscene. Um, 3 kids, all teenagers. I am bleeding money every time I go to the supermarket. I don't know about you. Market crashes. Again, extreme volatility we've seen in 2025. There is unemployment is creeping up. And I find that particularly, and we work with clients up and down the country, I'm finding that unemployment is worse in particular sectors in parts of the country. My lovely Wellington clients, really tricky. IT, challenging in terms of redundancy, etc. So that's not universal. And I do find there's an underlying worry about unemployment. I'm going to speak to that specifically. Please do not wait until you have absolute certainty. Um, that point in time actually in all reality never comes where everything is perfect and you have this right time to execute. It's saying, well, how do I do the best with what I have now to de-risk myself into the future? Recessions, we had the budget announced recently. Bye-bye KiwiSaver government contribution mostly. But do you know what that tells me? All of this stuff, it's just static. It reminds me of what I tell my clients every day. You cannot rely on external conditions, external support. All you can do is control the controllables. And those controllables are what you do every day and the strategy that you execute on. So that's what we lean into with our clients, and that's what we're leaning in tonight. And that composure and that sense of calm, taking stock, not reading headlines and derailing your strategy, flip-flopping, that composure is your superpower. And I think composure is certainly helped if you have a really robust financial plan. It just does. You've got it in writing. If you're working with somebody like a qualified financial advisor, you've got them walking alongside you to steady your hand. Calm and composure, absolutely critical. And there is a risk, and I see in our poll that we had, a lot of you have term deposits, savings, etc. And often we do that because we need a buffer, and a buffer is important, non-negotiable as part of any financial plan. We often do it though because we want that sense of safety and security. We don't want exposure to risk or loss. But if I'm honest with you, having money in the bank, kind of limping along, barely doing anything from an interest perspective, you almost guarantee you're banking a loss because you're barely keeping up with inflation. Please, part of tonight is making sure, yes, you have a buffer, 3 to 6 months of expenditure. Maybe there's a better place to put it than savings. We'll explore that. Absolutely critical that you have that resilience. But this is about something greater and really making sure that you put all of your money that you work so hard for to really good use. And what is wealth creation? Why do you need a wealth plan? Because making all of this happen requires a few different steps at different points. Repaying your mortgage early requires a surplus, and ridding yourself of debt, then you need to assess the opportunities to build wealth. And in saying that, am I saying that you can only think about this when you've paid off all your mortgage or debt? Absolutely not. But you need to get yourself into a point where you have capacity to grow wealth, and you have to assess the opportunities to build wealth. But often raising financially independent kids is what will prevent your plans in retirement becoming undone. So again, it's all these different components that come together in that holistic wealth plan. And it's founded upon a really strong foundation. We're not here to skip steps. There's no magic wand. You have to have a really strong foundation, ensuring your money habits are identified. We're going to unpack some of those together soon. Your financial goals are set. Your cash flow is managed. Cash is absolutely critical. It's the engine room of anything that happens next. Get your mortgage under control. It is a really important goal to get mortgage free on your family home, but we're doing a few other things sequentially as well. Ensure your insurances are optimized. Covering off risk is really important, but the balancing piece is you don't want to be paying too much, and you've got to get that KiwiSaver working as hard as you can. Can't believe that only 54% of you have KiwiSaver. We're going to address that. So your plan starts by knowing your starting point. So where are you at now? And sometimes it's really hard to assess by yourself. Where are you trying to get to in terms of goal? What is your retirement number? How long do you have? That is really critical in determining what strategies are available to you and where you lean. And you've got to understand, how does my behavior drive the nuances of my strategy and ensure that I don't just want to do something. I'm going to make sure that I do what needs to be done, because that execution piece is really, really critical. And obviously everyone's dealt different hands. And again, that's just an acknowledgement of where things are at for yourself. And when people come to see me, I remember doing this for the last decade. My youngest client, I think, is 24. My oldest client is 84. So if you're in that age bracket, I have worked with someone like you, I guarantee it. So when people come to us initially, we understand, well, where are you at? It's that diagnostic piece. And we ensure that we embed really good controls around cash flow management, because again, that's the piece that helps you grow wealth, pay off debt, invest, etc. If you've got short-term debt, we're just going to get rid of it. If you have a mortgage, we're going to optimize it. Not having a well-structured debt costs you money. I saw lovely clients today and they had a whole heap floating, far more than they could conceivably pay off in the next 12 months. So again, why would you do that? And part of assessing where things are at is making sure that we get rid of all of those inefficiencies, because I think we'll all agree that we have profit, banks are making enough profits. We don't need to be giving them any more interest. And again, getting crystal clear on your goals and time frames to achieve them and that behavioral tendency. And again, we're going through this soon. And in terms of cash flow management, to grow wealth, you need to have more money in than out at the end of every month. And if there's no money left over, this should be your first area of focus. And we've got a wee tip there to track your expenses. Often people will come to me with really beautifully color-coded spreadsheets of expenditure plans, but it's kind of meaningless if you're not tracking it in real time, because anyone can write a pretty budget. It's easy to color code it, but where are you at with said budget? So again, tracking is really important. I think another tip there in terms of creating more cash flow at the end of every month is to not use your credit card. We know that people spend about 15% more than they would otherwise by using credit cards, just because it's a less transparent form of payment. You know, you swipe your card, have I paid? Who knows, who really cares? But you never know where you're at. And I'm sure you're saying, well, I'm winning, I get points, Katie, you don't understand, I pay it off. But again, I understand that, but I also understand banks have to make profit for their shareholders. And again, we're here to help you. And that intentionality really does count in terms of structure. So again, I'm sure you are one of the people who would do better if you don't use credit cards for everyday spend. So just have a think about it again in terms of creating more cash flow to grow wealth. Debt holds you back far more than you think. Really critical that you have that tight mortgage optimization strategy. One of the tools that we use for our clients is we've worked really closely with the University of Auckland and our founder, Hannah McQueen, to know and design a calculus formula that tells us exactly how to structure debt, knowing that there's good debt and bad debt. The debt that we focus on first is any debt associated with your family home. And in essence, yes, 8 pages of calculus, but effectively what we do for our clients is we cut that into savings or debt reduction goals. So every year you've got a piece you're going to attack over and above what the bank wants you to do on your terms, not their terms. And again, crafting that mortgage structure and strategy as part of that overarching wealth creation strategy does give you more options. And I'll talk you through that with a wee graph. So for lots of people, you can see that default retirement projection. I think the average stats in New Zealand are people buy their first home at 35 and then it takes them 30 years to pay off that mortgage. I will not accept that for my clients. That might be the average, but I will never accept that for people who work with me. So in terms of that default projection, this is what everyone else is doing. So get mortgage free by 65, great. KiwiSaver in this example on average lasts until about 69 in effect, which means they have quite a chasm in terms of retirement gap that they need to create wealth to bridge. And for these people, paying off the mortgage at 65, well, great. They run out of money at 69. What a short suboptimal retirement, because in effect, one of my aims when we work with clients is to get you living your best life until at least age 90. That's at least age 90. In here, we have the gap from 69 to 90. And again, I'm just indicating the difference in the swing it can make to focus concurrently on having that really good mortgage structure and strategy. And we'll see more pushback on this as interest rates come down, mark my words. But in terms of this example, again, we get them mortgage free at 55. So again, much better than 65. Fantastic, which just means you have more time to save in effect. So there's more of a pool when you get to retirement, which means that you run out of money in this example at 80. But remember, I'm still not happy with that. I'm a hard taskmaster for my clients. We want to get you to at least 90. So to do that, we need to make sure that we execute on a wealth creation strategy. So yes, we're going to get you mortgage free as fast as possible. Of course you are. Of course we are. Of course we're going to scoop up what's left over in terms of cash flow, but we need to be making that money work harder so there is a bigger landing pad in retirement. And wealth strategies don't just end at retirement. It's actually the time where you need to adjust your strategy but still have one so that you can manage the wealth of the investments you have to make it stretch even further. So you can see how the red lines now indicate how you can take the wealth you've accumulated and begin decumulating assets and adjusting to appropriate post-retirement investments. And there are lots of wealth options, business, shares, bonds, managed funds, gold, collectibles, index funds, the term deposit, property, and they've all got different risks associated with them. And for the vast majority of my clients, we lean into, generally speaking, property and managed funds, and we'll talk about why that is. But first things first, for most of my clients, they're working towards retirement, which is why we reference retirement as an example frequently. But knowing how much you need, how long you have, and your tolerance to risk will influence the approach best suited for you. But you've just got to consider those natural tendencies to set a goal that's exciting enough to keep you motivated. And in terms of those basic personalities, how we define that is shopper, saver, plotter. So shoppers like spending money, savers, saving, plotter, somewhere in between. And I find those money personalities are quite closely linked to risk as well, not always. And you think, well, being a saver, having a tendency to amass cash, you'd be a sitter for making really good progress in terms of wealth creation. Not necessarily so, because what I find with lots of my savers, that they're quite good at amassing cash. They're just not that great at growing it in terms of taking risk. They seem to be quite risk averse. So again, great at amassing cash, not so good at executing on a strategy to grow it. And whereas savers, you've really got to make sure, like myself, that you have a goal that's motivating enough or sexy enough for you to try harder. But often my shoppers are willing to take a little bit more risk. Again, often saying, well, you could buy an investment property. Does that suit you? Holiday home, etc. That's quite motivating to shoppers, and they will rise to that. So again, it's understanding those layers in terms of what will be motivating for you and how do we push your buttons to make sure that you actually execute on a strategy that is true to your values. And understanding that starting point, for me, it's critical to understand where we are from that cash flow position. Most of my clients who first come to me are floating. Lots of people think that they're floating, but I actually define them as sinking, because if you come with any kind of credit card debt or short-term debt that you couldn't pay off immediately with excess cash, I think you're sinking because you can't correct past behavior. I want to get all of my clients to flying from a cash flow position, which is amassing at least 15% of cash left over to do something else with in terms of cash flow. So that's where I'm trying to get everyone to. And lots of people come to me flying, but then we're crafting, well, what do we do with that to make sure that we land longer term? And as we said, lots of options, but you've got to balance that out with risk and reward. Business, lots of potential upside, but also lots of risk. And in New Zealand, the stats around business success are less than favourable. Shares, lots of risk, lots of return, etc. And we're balancing out the investment that is right for you. Always depends on your goals and your time frames. And let's unpack some of those options in terms of pros and cons. So term deposits, we've talked about that. They're liquid, they're safe. Passive, easy to execute. It's a time commitment for what you need it for. There is such a low return. And again, often doesn't even take into account inflation. And what grates me, and again, this is not specific financial advice, but what grates me is when clients come with home mortgages and then they've got these term deposits. That makes no sense to me. Why would you have cash off to the side when you've got debt? Because you always pay more in interest on debt than you receive in savings. In that instance, I don't like that you have term deposits. I'd much rather that cash be offsetting debt on the proviso that you can re-access it. That just makes more sense to me in terms of making that money work as hard as possible for you. Pros and cons of managed funds. Lots of my clients lean into managed funds, particularly when they get closer to retirement. Why is that? It gives them that layer of diversification, but also that liquidity. And essentially it's like your KiwiSaver, but with less rules around it. They're managed funds. And again, what I like about managed funds for my clients, particularly closer to retirement, that the vast majority, they're spread across jurisdictions, countries, asset classes, etc. I really like that in terms of spreading out risk, managed on your behalf. And you can see in terms of different managed funds. See, this aligns perfectly with your kind of KiwiSavers, have different returns. So conservative, essentially kind of cash equivalents, got the lowest return, or versus an aggressive kind of 7.71. And if you don't need to access that chunk of funds that in managed funds or KiwiSaver, likely, you know, for a long time, then you want to get them working as hard as possible. So generally speaking, you'll take more risk. But if you were needing it sooner rather than later, then obviously you pare back that risk piece. And that's why it's really important to understand those goals and your cash flow planning into retirement. So again, really solid option. Most of my clients lean into that as part of their overarching plan, more when they're getting close to that retirement piece for the reasons I've stated. And property, lots of my clients invest in property. I think lots of New Zealanders invest in property. I think lots of New Zealanders don't do this particularly well, if I'm honest with you. And I'm not just saying invest in property. I'm saying, well, how do you invest in a really clinical property that's going to do what it says on the tin and help you to grow wealth? And so in terms of property, in my mind, I think one of the biggest draw cards for property is that leverage piece, which we'll talk to soon. It's the most stable asset class. Rent goes up with inflation. It's tangible. I think most people can understand property, but in my mind, it really is that leverage piece, which means that property outperforms other asset classes. And again, I'm going to do the maths around that for you. And if you're here to grow wealth and you have time and capacity, likely you need a property component as part of that overarching plan. Is it the only thing you do? Certainly not. But if you're here to solve a problem, if there is a large gap, likely as part of that overarching plan, you likely should be leaning into property. Drawbacks is, and again, if you need immediate cash, you can't sell half a house. So again, that's about having that balance piece and why that managed fund piece works particularly well as a component as you get closer to retirement because it is so liquid. Obviously, there's a high entry fee. Really critical, not all properties are made equal. I think for lots of people who invest in property, they're accidental landlords who I see initially. And what do I mean by that? You've gone to the bank and they've said, oh, well, you can keep your current property and when you're upgrading your other property to another property. So they keep their first home as their rental and then they buy another house. And again, not the wrong thing to do, but again, if you're serious about growing wealth, there's some challenges around that. And again, we're not here to muck around. It's about how do I execute on a really clinical strategy that gets you to where you need to be. And quite frankly, if your retirement gap is greater than 300,000, you're likely going to need to use leverage to bridge it. 60% of Kiwis haven't thought about how much they will need in retirement. So again, if you're not sure, not alone. But for me, that's the anchor of any of the financial plans that we design. And for many, well, particularly on this call, with only 54% of you with KiwiSaver, KiwiSaver's likely won't be enough. And that KiwiSaver, to be honest, was never designed to be the be-all and end-all of retirement, but it is an important component. The average KiwiSaver balance in New Zealand is 37,000. Balance for men is higher because women generally have time out in terms of rearing children, looking after people, etc. And there's that pay gap. I still think it's a really good idea, particularly for people who are in employment and their employer will contribute over and above their wage into it. If that is the case, and for most employers in New Zealand, that is the case, I would strongly recommend, if cash flow allows, that you match what your employer's doing. It's free money. Why wouldn't you do that? But anything over and above that, let's make sure you're channeling that really productively in terms of paying off debt if you have it or growing wealth elsewhere. Because again, great to get good returns, but flexibility is really important for my clients. And as part of plan design, I really want you to be thinking about, am I in the right, for the 54% of you who have it, am I in the right fund type? I saw some lovely clients this week, which is it's only Wednesday. How's it only Wednesday? That was yesterday, who were late 30s, already had their house, bought that like 10 years ago. Well done them. Still plugging away at the mortgage. But that one conservative KiwiSaver. I mean, again, if you have 10 years, if there's 10 years or more in time before you can access that, likely it should be in higher growth to really maximize your returns. So again, this is about making sure you leave no stone unturned as part of that overarching plan. And I think such a trick is to think, well, I only have to do one thing. That is absolutely not the case. We've got a really strong foundation, but we're leaning into lots of different options to make sure that we land where you need to. And your plan has to be dynamic. It is not lock and leave. And I think, sheesh, over the last 5 years, a bit of a rocky road, not going to lie. COVID, my goodness, we've had it all. And again, you don't just design a strategy and then lock it in concrete. If it does, it quite quickly becomes irrelevant to you. You've really got to make sure that as time goes on, you're always assessing it to make sure, is it doing what it should? Is it working as hard as possible for me? And again, just unpacking that leverage piece around property. That is the beauty around property. It's not that it gives you exponential gains. It really doesn't. The beauty around property is you put in your money, the bank puts in their money, and you keep 100% of that gain. Over time, leverage property outperforms other asset classes, less volatility. And again, just going to illustrate that to you in numbers. So we have a asset valued 160,000. So we've got savings, you've popped it in a managed fund, you're getting a great return at 6%. So again, there's no tricks around this math. 160,000 at 6% is just under 10 grand. The beauty around property is you take that 160,000 as a deposit on an $800,000 property, you're getting returns on that 800,000. So that's a 48,000 return. So again, not that it's amazing, it's just that you've acquired a bigger asset that goes up in time. And again, I really like an element of leverage in my client's plan because I think that's really protective, that debt when there is inflation in particular. But again, good debt and bad debt. Good debt in terms of productive asset, bad debt versus home. We just want to get rid of it. It's just dead money to us. And again, just reiterating, the best approach for you really does depend on your time frame. And again, just emphasizing there is never a perfect time to do any of this. There really isn't. So if you're waiting for that, you're going to be waiting a really long time and it's going to cost you money. That goals piece, really important. What are you trying to achieve? I know that down to the dollar for my clients in terms of end position and what we're trying to achieve every year, every quarter, because again, how can you hit something you can't see? Risk appetite. Now that's really interesting. And I think that often if that isn't serving you, you can circumnavigate that by understanding the cost of inaction. For example, if you are, and I'm a chartered accountant, remember, um, that risk appetite, if you are conservative, I absolutely can relate. I really can. But you've got to understand the opportunity cost of doing nothing. You really do. And that can be the most costly thing. So I think often that risk appetite can be challenged and you can be brave enough to take on risk if you de-risk other areas and you understand the cost of inaction. That cash flow piece is important. On average, people fritter about 15% of their net income in New Zealand. A little bit of overspending, a lot of paying too much interest to banks. My job is always to find that and put that to better use, which exponentially helps that cash flow piece. That flexibility is really important. I will never lock and load a strategy, but often people put so much effort into the initial acquisition of the investment strategy, which absolutely you want to get that right, but you got to marry that with that hold strategy. How long do I hold this asset? Really critical. And again, I think lots of people they're waiting for the bottom of the interest rate cycle. They're waiting for the bottom of the property market. Again, I don't have a crystal ball, but it feels like it's pretty good right now, in all honesty. But again, you only know ever that it's at the bottom of the market when it rises again, and you look back and you think, ugh, shoulda, woulda, coulda, in terms of returns. So again, that access to equity is important and mortgage lending, because don't be thinking that the bank has an infinite appetite to lend you money. I'll tell you right now, they don't. As you get older, it's harder to borrow money. So you might think that your stars have aligned, but that window has closed, because over 55, it does get quite challenging in terms of accessing additional lending. So again, all of us, we're kind of on the clock. Is it ever too late? Certainly not. But again, I'm always like, rattle your dags, team, let's do this. Because once it's done, again, you've got that compounding interest in time that's working for you versus against you. And again, I've said this a lot, but inaction costs you more than you think. Questions we might ask ourselves currently: is now the right time to start? Yes. Should I wait until interest rates are optimal? No. What is optimal? Can I figure this stuff out myself? Well, I think that I love that there's been a democratization of information. I really love that. AI, there's lots of information. But I think what that has caused is that often we feel like we're almost drinking from a fire hydrant in terms of possible things we could do and information. and it's absolutely meaningless to you if you don't take action and do the right thing for you. So you could work it out yourself, but how long would that take you? And what is the guarantee that you get that right? And I think for a lot of people, that comes down to outsourcing that expertise. Should I wait until the economic turbulence dies down? I've been waiting for a while. But again, no one has a crystal ball. No one has perfect information. You've got to think yourself, well, what is the cost of not doing this into the future? And of course you can wait, but understand what is that delay costing you? And again, some people come into me and they're on track to be mortgage free in say 20 years. And I'm like, yep, great. Let's clean everything up. Let's build that really solid foundation. I'm going to get you mortgage free in 10 years. And they're like, amazing. And I'm like, amazing. But when I say that, I'm not saying that for 10 years, we're just going to plug away on one mortgage. Great to get mortgage free in 10 years. We celebrate. We've got a bell. We ring it. We're excited. I'll send you out a bottle of champagne. We delight in that, but you can't eat your house. And in reality, if you just focused on paying off a mortgage over that 10 years on one property, the cost to you of doing that is that you haven't tapped into that equity of that property. The cost to you of doing that is that you don't have another appreciating asset through that cycle, which is property cycle, which is about 10 years. So again, it's understanding what do I focus on in what order and what is the cost of inaction, I think is really important. And there are lots of common mistakes that people make, that lack of diversification. And again, am I saying you do just one thing? Certainly not, but it's where do I lean? So if I am trying to grow wealth, I am likely leaning into that property piece. If I'm nearing retirement or in retirement, I'm more leaning into that managed funds, which gives me that diversification and liquidity. Not prioritizing short-term debt. Oh, that's great. So many things annoy me. Sorry about that. Actually, I won't apologize. I'm here to get results for my clients, and we are laser focused when we look at their plan and we make that position work as hard as possible for them. And again, why do you have niggly credit card debt, like 20% interest, and muck around with, oh, I want to invest in shares? And it's like, well, let's address what you're paying after tax 20% on. Let's get rid of that short-term debt. And then we lean into that wealth creation piece. Waiting too long to start, that is so grating. And again, there is never a perfect time. You start today. What is the best thing I can do today? You start and you are consistent with your strategy. Investing everything without leaving an emergency buffer, as I said, non-negotiable. If you work with us and enable me, you're going to have a buffer. That buffer is going to be at least 3 to 6 months, likely 6 months of expenditure. But again, that's got to be working for you as well. Like we said, if you have a home debt and savings, that makes 0 sense. So again, everything has to work as hard as possible for you. And I think that lots of people make emotional decisions. Remember, I said that composure and that sense of calm, not listening to barbecue chat, not flip-flopping in terms of headlines, that will serve you if you hold your line and you are consistently executing on that strategy, that compounding piece, that dollar cost averaging, that will serve you. And when is the right time to get started? Someone sitting in the shade today because someone planted a tree a long time ago. Famous Warren Buffett quote. And I always say, we start today. Should it? And again, lots of people come to me, they're like, should have done this like a year ago, should have done this 5 years ago. I don't care. You are here today. You can't change anything that's happened. You look forward. Shadows fall behind you. And again, a wealth plan has to be flexible. It has to be dynamic. It is not lock and leave. It's got to have buffers. I love that saying, anyone can have a plan until they're punched in the face. And a lot of my clients have been consistently, it feels like punched in the face for the last decade, but they've never knocked us out. Why is that? It's because that plan is flexible, because we did what needed to be done at that time, and we made sure that we seized opportunities. Because it's really interesting when people initially come to me, I say to them, well, what do you think will happen if you keep doing what you're doing? Most people say they'll be fine. Lots don't, but vast majority say they will be fine. And I think what drives people to see a qualified financial advisor is they do not want to miss out on opportunities. They look around and they often see people doing better than they are, and they want to know the secret sauce. And again, in my mind, there's no secret sauce, but there are really good, solid, clear rules where you lean into, you will do better. In terms of key takeaways, this is my amazing team. Cast of thousands up and down the country, an amazing team. I am so proud to work with them. But just in terms of key takeaways, right, I'm going to get back to that slide. Can you see that slide? Key takeaways. Here's what I want you to remember as we wrap up tonight. Wealth building is it's not complicated, but it does require intentional action. You now know the formula. Be ruthless with cash flow. Every dollar left over is a wealth building soldier. Kill that mortgage debt is the fastest guaranteed return you'll get. Execute systematically across investment properties and funds. Know your retirement number and work backwards from there. And remember that retirement number to me is what does it cost you to live a happy life? Understand that. And that's what we need to fund until you're 90 as to when you retire. So if you're retiring at 65, I need us to be able to facilitate that number through passive income or assets that we eat into from 65 to 90. So 25 years at least. That is our anchor. I think it's really important to partner with an advisor who'll keep you accountable and efficient. Knowing what to do is one thing, doing it is another. And I think for a lot of my clients, of course, I know structure, of course, I know strategy. I think a big component of my client success is a little bit of external accountability. You always do better when you work with somebody else. You lift your game, you do what needs to be done, and you get there in the shortest amount of time. And honestly, I think the biggest risk isn't market volatility or economic uncertainty, it's inaction. Every day you wait is a day of compounding growth you will never get back. So in terms of today, I promised you a wee special. You have everything you need to start building serious wealth. The question isn't whether you can do this, it's whether you will. Here's how to take action right now. I'm offering you a 90-minute initial financial diagnostic meeting with one of our qualified financial advisors like myself, up and down the country, face-to-face video for just $99. That's $301 off the regular $400 price. But this special offer is only available if you book before before Friday. So end of play Friday. Today is Wednesday, so you've got until end of play Friday. After that, it goes up to 149. Still pretty good, but not as good as 99 until the end of June, and then it's back to the full price of 400. This isn't just a chat. It's a deep dive into your current financial position, your goals, and a clear roadmap to get you there. 90 minutes that could change the trajectory of your wealth forever. Your future self is counting on the decision you make tonight. Don't let fear win. Start today. Thank you for joining us. And remember, wealth is for everyone, including you. Right, as promised, questions. So Jess, have you been collating questions?
Yes, thank you so much. Another stellar webinar, Katie. Thank you. We'll dive into some questions. Before we
Great.
do, can you just toggle back to the slide with the QR code just to
Oh,
give
sorry.
everyone a chance to scan that? Thank
Yeah,
you.
no problem.
We had a few really good questions come through live, starting with one from Michael. Can this be for couples as well with the financial consultation?
Oh, such a good question. Yes, we insist actually. So if your finances are combined, we definitely want to see both of you. Joint plan, I think it's really important to get you on the same page. You always do better when you execute together. So yeah, thank you. Yes, we insist actually. So yes, please.
Thanks, Katie. The slide that is showing, oh, it just keeps
Okay. Oh
going
my
back.
gosh, I'm not good at slides.
All right,
Great at financial advice.
it's there, so let's not touch it anymore. Thank you. So there was another one that came through from earlier in the piece around tracking your transactions. Are there any
Mm.
apps you would recommend, Katie?
Yes, we have our own tracking app, MoneyFit. It's absolutely fantastic. It's kind of like Zero, but for personal finances. So it strips in transactions on a read-only basis. So you can say, well, what do we want to do? What am I actually doing? And again, that's kind of the fuel of your strategy. I will say though, tools in isolation do not get you ahead. It's making sure that you have a strategy that you stick to and that you execute on consistently. So again, love to track spend, but tracking in isolation likely will show you that you're quite good at spending money. What we want to do is say, well, what do you want to spend? What does that mean to us in terms of retirement? Because again, that's evidencing to me your happy life and how we're going to facilitate that in terms of 65. It also, if I was looking at it, would show me how we structure any debt that you have and what else you should be doing from a wealth creation perspective to make sure that you land where you need to in terms of retirement. So great track spending, great question. We have an app, MoneyFit, that does that, which again is important to increase the consciousness to understand where you're at, but we want to elevate that as part of that holistic plan.
Thanks, Katie. And for everyone who's interested in MoneyFit, I've just popped the URL to the MoneyFit track if you do want to have a look at it. Next question. Another one that came through live. Let me find it again. So for the emergency fund, what would you
Mm.
recommend around how you can get it working better? Are there any types of savings account you would recommend?
Yeah. So again, it depends in terms of age and stage. And remember, we work with lots of different age and stages, 24 to 84, but also it's not sequential either from an age perspective. We see lots of people who are starting again in terms of relationship breakdowns, illness, etc. They need to get to the same point, but they're going to get half the time to do so. So we do work with lots of different people. And what was the question again?
Just where would it best be placed
Oh, the
to put,
savings,
yeah, for
right,
your
the buffer.
emergency fund?
So if you don't have a property, I would say high interest savings account, etc., that's accessible. If you do have debt or a mortgage, I say have that sitting in a revolving credit, offsetting debt, but you can re-access it. So, and again, if you're in retirement, you want that to be, it could even be in funds, which are quite conservative, liquid, not you don't want to be exposed to much risk, but still doing what it should. So that's kind of the different scenarios. But again, most importantly, if you have debt, likely it should be offsetting it.
Thank you, Katie. A question around the financial consultation. So for
Yes.
the $99 special consultation offer,
Mm.
how does this work? Will there be follow-up appointments or is there an action plan at the end of the 90 minutes? So can you
Yes. Yeah, no, great
give some more
question.
detail?
So, yeah, essentially, you will fill in some information in terms of your current position, but essentially, in that 90-minute session, you're going to jump on the financial scales. We'll determine where are you at now? Where do you want to be? Are you on track? Could you do better? And what does that could you do better look like? So, essentially, it's a Sharpie level view in terms of the principles we think you should execute on going forward, and we'll summarize that in a wee email to you in terms of focus thereafter.
Thank you. We just got a comment from Maria, who has just booked a consultation. Thank you so
Well done,
much.
so brave.
We are running out of time, so I will just give you one more question. Sorry if we didn't get to anyone else's. I've seen there's one around property, and if
Yep.
you are interested, we're going to be running another webinar with Katie that will
Oh my
dive
grind.
much more deeper into property. So please come along if you are interested in learning more. But last one, let me find it. So is property investing essential to building wealth? Or, yeah.
No, no, it's not essential. There's lots of different options, but I always think as we craft our plans together, at minimum, I need to get you mortgage free by retirement and have amassed enough to fund that good lifestyle until 90, whether that's in assets that we can eat into or funding. Likely for lots of people, if there is a gap in terms of what they're currently on track where they're currently on track to land and that number that I need to get you to, if the gap is more than 300,000, likely I would highly recommend you lean into property. And again, leaning means not everything, but lean because I need to introduce some leverage to turbocharge that capacity to make sure again that you land where you need to. So again, it's just dependent on age and stage whether you have capacity. It's not essential, but again, if you're serious about growing wealth, likely we need a component of property. But can I please emphasize, I am not saying just buy property. You've got to be really clinical around what that looks like. What do we spend up to? What does it need to deliver to you? What is the yield? So it's not going to place too much pressure on you. And the componentry of that, I am very clear on for my clients. And again, for them, it is a strategy to grow wealth. You get it managed, not here to muck around property. It is a strategy to grow wealth. And again, sometimes we have to unpack the emotion around that in terms of clients. Yeah, no, you don't have to. But again, and if you do land in not, we have to understand, well, what is that costing you and what else do we need to do to replace that?
Thanks, Katie. Just one
Welcome.
last comment from me. I can see that some of you are having trouble scanning the QR code. You can access this page if you type enable.me/wealth creation with a dash in the middle. So I've just popped that in as a comment if you want to quickly copy and paste that so you can
It
access
is a great
the
offer,
page.
I must admit. Yeah, I
Yes.
actually flippantly said it in May, and then we're like, oh, I'll do it in June as well. So it is a great offer. And again, I think that for lots of people, that independent assessment of capability is just invaluable. And we know our stuff. We've been doing this for the last decade, and everything we do has our clients at the center. And I think that's really important. And it's such a privilege to do what we do. We love our jobs. And again, it's about understanding, well, what are you capable of? And how do we execute on that? Because the knowing and the doing, we are leaning into doing. You're here tonight, we're leaning into doing.
Thanks so much, Katie. Thank you so much for your time, and thank you so much for your time, everyone else, for joining us. And yeah, I'll leave it with you to close off.
Fantastic. Well, I hope you enjoyed the webinar. I've really enjoyed. I'm sorry we couldn't get to all your questions. Come along and have a consult. We'll answer your own questions, but have a lovely evening. And if you're watching the recording, enjoy your day. Take care.
Thanks. Bye.